I have so many questions for you after the day we had yesterday. What a day.
It was a busy day yesterday.
It was a busy day. How did you spend the day? Just looking at the markets to see what was coming next?
No, yesterday was a fairly orderly decline in markets. So markets are well behaved, well structured. So it was a day where we were able to continue to focus on our long-term investment portfolio, how we're trying to create competitive advantage, how we're trying to deliver for our clients.
What do you think is coming? What are markets looking at? Are they looking at recession, or they are just like really scared of inflation?
Markets are really afraid of the inflation story because that ties back to the Fed's policy path and how high are real rates going to go. And what we're seeing in the markets is a rotation from growth stocks with earnings very far in the future towards stocks that are much more value stocks, earnings here in the present. And this reflects the fact that real rates, for the first time in a very long time, are likely to go positive in 2023.
And that freaks out the markets.
It changes valuations. It just completely rewrites the valuation playbook, which has been one of people really able to invest in growth because earnings in the far, far future still had a very high net present value.
Is a recession now inevitable?
Well, okay, in every economic cycle, it ends with a recession. So yes, a recession is inevitable. The question is when, timing-wise. And we don't think a recession is likely over the course of the next, let's call it 4 quarters for sake of the argument.
And then what happens after 4 quarters?
To put the sort of, finger on when a recession is going to occur has been a failing endeavor of every policymaker for the last roughly 50 years. We don't know what causes recessions to start. We know the ingredients that create the kindling wood that allows recession to happen, but what actually is the tipping point's often unknown. There's some really important sea changes taking place globally. China's zero COVID policy continues to put real impact on supply chains, which is incredibly pro-inflationary. That creates more of an impetus for the Fed to have more aggressive policy decisions, which could cause a recession. The war in the Ukraine, of course, is creating chaos in the energy markets in addition to the horrific humanitarian crisis. And the war in the Ukraine, if it were to take a market turn for the worse in terms of Russia's willingness to engage in acts that are beyond comprehension, that, of course, could be a tipping point into a recession. Again, low probability, but very high severity. So we don't know what will be the tipping point. Generally speaking, recessions come from companies that pursued growth initiatives with frankly, pretty poor prospects. They overexpand into areas outside their core competency. Earnings start to dissipate. The economy starts to wobble. Higher interest rates, for example, housing market slows down would be an impetus. And then they start to reduce the size of their workforce to cut costs to try to navigate through that more difficult period of time.
What happens to the U.S. consumer? And actually, was it that triggered yesterday the sell-off, the fact that maybe it's weaker than we thought?
Well, actually, the data yesterday wasn't about the weakness of the U.S. consumer. The data yesterday was about the inability of corporations to pass costs through to consumers. Now, how much of that is demand elasticity? Probably very little. Much of it probably has to do with just the time it takes companies to reorganize their affairs to deal with just the litany of supply chain challenges they're facing, everything from transportation to goods procurement.
But Ken, just to be clear, so you think that if you're a Walmart, you can pass on these, costs going up to your consumer without a bite back when inflation is already up and everything else they buy?
Look, if you're Walmart, you just saw Target's numbers yesterday, and you're going, yes, I'm going to be in a position to put cost prices through, increases through, because both these firms have to. I mean, the bottom line is they're not in a position to absorb the entire supply chain shock themselves. They're going to be putting price increases through.
And the consumer can take that?
The consumer, let's be clear, take it. I'm sure what that means. For a family that's in the lower quartile of income, this is a really tough situation, okay? They're going to have to make some pretty painful decisions in terms of consumption trade-offs. I mean, this is why productivity growth is so important. This is why the right policies out of Washington are so important, because inflation really impacts people who are living paycheck to paycheck most aggressively.
So in the next quarter, are we looking at stagflation? And again, what does that do to the S&P 500? When do we hit bottom?
Well, I don't think we're not stagflation yet. Okay. Yes, GDP growth in Q1 was a disappointment, but we're going to see positive growth over the next couple of quarters. Let's take a huge step back. Unemployment is 3.6%. There are 11 million open jobs. These are numbers that look nothing like gloom and doom.
But so what are we living through?
We are living through a shortage of workers, and we are living through a change in the policies of globalization that defined most of our adult lives. So with the workforce, we're the American workers. We still have fewer people employed today than we did before the pandemic started. We should have several million more Americans working. And we need those people working because that's how we satisfy the demands of the American consumer. And then for our entire adult lives, we've lived, by and large, and this is an uneven set of benefits, but we've lived through the benefits of globalization, which has been incredibly impactful in reducing the cost of goods. Now, we know some of the impacts this has had on towns with single manufacturing businesses that have been shut down and destroyed by offshoring. But as we roll back globalization, as we go to more insourcing, we're going to see that huge benefit of trade dissipate, which has been so helpful in containing inflation rates.
But so that's going to be inflationary.
That's inflationary.
And what does that mean for the markets?
So again, you've got these two inflationary problems. You've got a shortage of people in the workforce. You've got this impact of deglobalization that causes this inflationary environment that we're in. That's going to cause the Fed to have to raise rates. And at some point, we're going to go from a negative real rate environment to a positive real rate environment. And the stock market is seeing that play out. They're forecasting that, and they're incorporating that into stock prices. So stock prices go lower, growth stocks go much lower, value stocks outperform growth.
How much lower for a correction do we need to see before we hit bottom? How do you see that, actually? How do you tell it's bottom?
You don't know. I mean, like, look, if somebody here has the bottom indicator, just my phone number, I'd love to know that, and everybody in this room would love to know that, and everybody who sits in front of a Bloomberg terminal.
You have the crystal ball, Ken, do you not?
I don't have the crystal ball at all. Like, mine is just dark when I look into it. I can't see anything.
Do you have a fund that's actually just net short?
No, we do not have a fund that would be in any meaningful way net short.
Why not?
Over time, we bet on the growth of the American economy.
What does this all mean for active investment? It should have been back.
So active investment drives our equity markets. Drives it. And in fact, this is one of the real apprehensions that I have with a number of the SEC's most recent policy proposals, is they are reducing the ability of active managers to deploy capital and to earn the benefits of their research. And the great savings of American retail investors by having access to index funds is predicated on markets that are efficient. Markets are efficient because of active investors. So ironically, one of the great sea changes in our lifetime has been the rise of passive investing. It has saved American households countless tens of billions or hundreds of billions of dollars. I mean, the numbers are staggering numbers. And the SEC, in their effort to make active investing less attractive, this is like the policies for the equity market that parallel our energy policies of the last 2 years. We've got higher prices of gasoline at the pump because of poor decisions out of Washington, and we're about to make our markets less efficient if the SEC's agenda is pursued.
So how would you change the equity market?
The U.S. equity market is unquestionably the envy of the world. It is the single most efficient competitive market in the world, hands down. Now, this doesn't mean there's not room for improvement. To be clear, it's in a variety of technical details that isn't that interesting. We published plenty of white papers and comment letters on this. I think I'd put the audience to sleep in about 3 to 4 minutes.
Not if you do it in 20 seconds.
Yeah, but I can't do it in 20 seconds because it's just not that interesting, and it's all highly technical. So to be clear, there's room to improve the U.S. stock market. But the most important thing we can do for the U.S. stock market is to ensure that we have a very vibrant and community of active investors that engage in research, price discovery, and commit their capital against what they're doing. That's the most important thing we can do to make our equity market really serve the needs of corporate America and the American public. The other thing we need to do is we need to think about how do we make the American equity market attractive to corporations to be a part of. Yeah. The rise of private equity is really a testament to the difficulties and challenges of being a public company. We should think about how do we have far more companies be public companies where their success is enjoyed by American investors, saving for the retirement or otherwise. And everything that we keep piling onto the list of obligations and responsibilities for a public company discourages that from happening. We've seen thousands of fewer companies in our public markets today than 25 years ago. And that's really, I hate to say it, but shame on Washington for really forcing so many investment opportunities outside of the line of sight of the American investing public.
And so, Ken, you don't think this comes from a place of actually trying to keep more people safe when it comes to public money?
Wow, so if we're going to try to force everybody into T-bills, that hasn't worked so well. The American investor in T-bills over the course of the last 2 years has lost about, ballpark, 15% of their real savings. So I'd call that a really big policy failure if we think safety is everybody in American public has to invest their money in T-bills.
I want to ask about liquidity. Is there going to be a liquidity problem in the markets? And is that one of the biggest concerns that markets are actually not talking about?
You know, I think that people use the word liquidity in a very, loose way, okay? And there's various forms of liquidity that matter to markets in various ways. The biggest challenge we have this year in the market with respect to liquidity is the very low rate of new capital formation. So we're seeing a real dearth of new equity market deals, IPOs. And that's problematic because that's the lifeline of the entire venture capital system, which has been so important to the American growth and productivity story. So fewer IPOs, fewer ability to exit investments for VC firms leaves us short capital to invest in the startups of tomorrow.
But why is that? COVID?
There's a litany of reasons, and part of it is people are dealing, number one, with their losses in their growth stock portfolio. Number two is chaotic market environments become all-consuming with respect to your current portfolio, and you just don't have time to look at new ideas. I mean, on a day like yesterday, if somebody calls and says, hey, we've got this great IPO, you're sitting there going like, I got enough problems on my plate to not talk about a new investment opportunity.
How often do those come up, actually? How often do you make a decision on a new investment opportunity?
How often do I?
Yeah.
Rarely. The people that work for me are much better at most of these decisions than I would ever be.
But how many proposals do you get?
I mean, like proposals, it's like an endless number, but decisions is very few.
How has COVID changed the way you work and how hedge funds work?
You know, that is very mixed across the industry. One of the big changes for us was the lack of access to corporate management teams. You know, we are so intertwined with corporate America in trying to understand business models, the value proposition for consumers, how they're going to take the business forward in terms of new R&D and new projects. Losing that connectivity to corporate America when we went to a world of Zoom-based calls that became very anodyne. That was a big loss, and that was a loss for efficiency in markets. So the last few months have been a wonderful sea change, that we've had so much more connectivity back to the companies that we support and back in understanding how they're going to evolve their businesses. You know, for us, the world post-COVID looks very much like the world pre-COVID. We're all back at work around the world at Citadel, absent a few jurisdictions in Asia. And that collaboration within our four walls, I think, has been an incredibly important part of our success story over the last 2.5 years. It's something that I wish all of corporate America would embrace, because what you see, and there are more and more studies emerging on this, innovation and creativity fall in a remote workforce. And for us, so much of how we create value in one form or another involves creativity and innovation. And having everybody back together has been really powerful in driving forward our overall business.
And it hasn't hurt keeping talent or hiring.
You know what? We lost a handful of people over the course of this journey. You know, let's be clear. The first 2 or 3 weeks back for most people was like, oh, I can't believe they made me come back to work. And then in December, when we saw Omicron reaccelerate, we told everybody on December 14th, go home for the holidays. Like, this wave was going to sweep across the United States. we'd had an outstanding year. Everyone had given it 110%, and most people kept coming to work. So what it's really a statement about is we're creatures of habit. And we create new habits pretty quickly. And when your habits turn back into, I go to work, you start to say things like, I actually enjoy the separation of my personal life and my professional life. I mean, I can't tell you how my colleagues are like, it's actually really nice to be in a room and not have to deal with like managing 25 different distractions at home. So I think most importantly, we're creatures of habit, whatever those habits may turn out to be. But for us, the chance to collaborate, the chance to work together, the chance, there's been so many meetings over the last 2.5 years in front of whiteboards with new insights, new concepts. That would never have happened in a Zoom-based world.
Citadel has made money when a lot of people haven't. What's your secret sauce?
Look, I think I just spoke about the most important one. It's the fact that we work together as a team.
Everybody says that. What's your real secret sauce?
No, it's really simple. Many of the best people in the world of finance work at Citadel. And they work together at Citadel. And they work together at Citadel in a very powerful way, both from a research perspective, from understanding what their comparative advantage is, from being disciplined. We talked about decision-making. We're very good at pushing decision-making through the organization. I have a very simple principle. The most junior person who is qualified to make the decision should make it. And that develops talent in a very profound way. It allows our associates and analysts to become world-class portfolio managers in a very short period of time. And my portfolio managers are incredibly empowered to be decision makers because they've been practicing decision-making for years. And so I think one of the things that really makes the place special is you walk in and you read a news story and you wonder, like, what should we do? And then you call the portfolio manager and he's like, no, this is what we did. Like, they've already read the news story, they've thought about the situation, and they've acted.
So given all of this, where do you and your team see the next opportunity in the markets?
Look, the markets today are awash in opportunity in almost everywhere that we invest. I mean, there are every day there is something to do. No one sits around and goes, there's nothing to do today. And it comes down to, again, in a business that's predicated on research, it's about idea generation. It's about what differentiated view do we have, whether it's about a commodity, credit, and equity that's different than consensus. And when we have those differences in perspective, that's where we deploy our capital.
Is there something that you think is particularly attractive, either an asset class that others aren't seeing or a part of the world?
No, I actually don't. I think about all the different firms, our contemporaries that we speak to and compare notes with. Everyone today is information flows pretty seamlessly across the market. Okay, so the big debates are around the path of the Fed. But there's nothing in that debate that's sort of like, wow, never thought about that. Commodities is the other big debate. And in particular, where is the US going to go with energy policy? How fast is Europe going to be able to pivot away from the impacts of the war with the Ukraine? What does going green mean? And in particular, now that we've seen some of the shortcomings of policies that were out of sync with reality and the devastating impact on consumers, the regulatory issues are coming back into play in a powerful way. That's unsettling. That takes away from the productivity of our industry. But thematically, the big themes are known. Mm-hmm. And the key question is how well can you formulate your differentiated opinion from others? That's the key question.
Very well.
So I think, for example, we're a bit out of step with many people. We don't think a recession is going to happen in the next couple of quarters. We're not surprised by the equity market move. You see that in our performance. But the fact that we don't think a recession is about to happen is a bit of a differentiated view.
Where are you on energy? So when you look at this, the energy policy, it was a mistake maybe to underinvest given the transition. What happens in the next 2 years?
So energy policy, both in the U.S. and Europe, has been just a train wreck for the last couple of years. I mean, the Europeans, focusing on reducing, and let's be clear, for some good reasons, but if you want to go towards carbon zero, you don't shut down your coal plants and your nuclear plants.
Because you need a plan B.
Because you got to have power somewhere. And you're not going to create enough power from wind and solar. So the Europeans had energy policies that were just not thought through. You don't shut down your nuclear fleet while you're shutting down your coal fleet. You're going to leave yourself in too fragile of a position. And then Germany's willingness to be so intertwined with Russia in terms of energy dependence was just sheer insanity. And Nord Stream 2 was just like the case study of this. Like, let's just double down on our energy dependency for Russia. And I'm pretty confident that the U.S. would have been much more supportive of Nord Stream 2 if the Europeans had concurrently made a decision to build LNG import facilities, so they would have a plan B. But there is no plan B, and we see the consequences of this. We see a situation where we've imposed draconian sanctions on Russia as we buy hundreds of billions of dollars of energy from them around the world. I mean, this is just crazy. We fund the war on the one hand by buying their energy, at the same time we're trying to impose sanctions.
So what's the way forward in this?
So the way forward is the world, if we're going to hit the goals of lower carbon, we're going to have to embrace more wind, more solar, nuclear, and again, natural gas is an important stepping stone to a greener world. And we're going to have to stop the anti-fossil fuel rhetoric that includes natural gas, because natural gas is the cleanest path to a lower carbon footprint. And so we're going to need to see more LNG production onshore in the United States, more liquefaction capacity both here in the Middle East, and more offtake capability in Asia and in Europe.
So does that mean you're pushing back the transition? Or is it you kind of suspend it for a bit and then accelerate it afterwards?
Or you might think about how to do it thoughtfully rather than from a demagogue or ideological perspective, right? Like, we want to get from A to B. How do you get there thoughtfully is the key question, not how do you get there in a way that's politically expedient.
Your take on crypto?
Yes. So I have no wallet. I own no crypto. I don't know what else there is to say.
I mean, some of your peers are actually expanding quite aggressively in crypto. Is there any FOMO at all?
Well, I mean, like, look, who doesn't have like some regret having not bought Bitcoin back at $1? All right. So, I wish I'd known Apple from when I was a child too, but I don't. So there's always, all I know is that if I could replay history, we would have done much better. Now, having said this, in all seriousness, a number of my colleagues are very excited about crypto, and they're excited about it for a litany of legitimate reasons. You'll see Citadel Securities start to make markets in cryptocurrencies. I think in doing so, you'll see another very responsible participant in the market that creates liquidity. I do think that the Terra Luna just catastrophe should be a wake-up call to DC to actually focus on thoughtful regulation. And in particular, stablecoin, by virtue of its name, almost demands being appropriately regulated. Bloomberg's done some phenomenal work on Tether. What's behind Tether? The fact that we don't know is utterly absurd. So if you're going to represent that you have a stable coin that's worth $1, you better damn well be able to back it up with custody accounts that show you the assets that define that stability. And the Terra Luna fiasco, I mean, you saw people lose their entire life savings in 2 days.
But do you think was it almost like a run on the bank? Is it the beginning of the end, or will we see more regulation?
I'd like to see thoughtful regulation. I'd like to see the SEC really carve out their view on what is a security, what isn't a security. The market, I think, after all these years, deserves certainty in that dimension. And then just as we have daily disclosures of the ETF holdings, we should have periodic disclosure of what backs the stable coins so that people know if their money's safe or not.
Ken, talk to me about Melvin Capital. So it's giving up and shutting down. Did the founder speak to you before?
I did not speak to Gabe in the last couple of weeks.
Was it the right thing to do, though, to shut it down?
Look, this is Gabe's business. It's Gabe's personal decision. I'm not going to second guess his choice in life.
But what does it mean for hedge funds in general? Are we going to see more episodes of some of these retail investors?
Well, I mean, the average hedge fund lives for about 3 years. So several hundred shut down a year, and the world goes on. Gabe was certainly an iconic investor over his career. Over his career, he did an incredible job for his investors. Kudos to him. We all react to adversity in different ways. He went through a really tough run. He chose a decision that worked for him.
What's the overall thinking on these retail investors, though? Are they back? Was it a black swan? Is it something?
You mean the whole sort of meme stock phenomenon
yeah,
that got Gabe in trouble in GameStop last year?
Yeah.
It's probably a moment in time. You know, replay the history. You've got this enormous stimulus program from the federal government, sending checks to tens of millions of American households. And a fair number of those households did not need the cash. They put it into the stock market. And people were looking for connection. They were looking for something to be involved in. You had the rise of the Wall Street bets and the whole Reddit phenomena. And I don't want to say our stock market devolved into entertainment, but there was certainly an entertainment dimension that came into play with money that was in some sense just dropped out of the skies into people's wallets. And they took a run at the stock market and GameStop and AMC and dozens of other meme stocks. I like to think it was a moment in time. I like to think that's the case. It's not how capital formation works best. And frankly, a lot of it came from a place that I don't think it was very healthy, which is like, let's try to take a firm like Melvin and put them into bankruptcy. Like, great. So you basically help wipe out the pension plans of teachers. You feel good about that? It's not Gabe's money that you're taking down. You're taking down the money of a pension plan that belongs to a teacher. So I don't think it wasn't a very good moment in American capital markets history, but I think you have to replay history and go, where were we as a country? And people were locked up in their basements, kind of losing their minds.
So it's a COVID phenomenon.
It's a COVID phenomenon.
Have you been on Wall Street Bets?
Of course I have.
And?
There are some great videos of them trying to attack Citadel. I noticed that we always seem to stand in the end, but there's some really great videos done.
Such as? Now, everyone's going to Google instead of listening to what you have to say.
You can go Google and have fun on Wall Street Bets, entertain yourself.
Ken, talk to me about regulation. Is there any part of the regulation that the SEC is going through that you think is a good idea?
Well, I'd love to see Gary Gensler pivot from talking about regulating cryptocurrency to actually giving regulatory clarity. I mean, from my perspective, that has been the giant regulatory failure of the last 2 years. We've seen $1 trillion change dollars wiped out of value in the crypto space. We saw the Terra Luna disaster just like hit right at people's pocketbooks in what they thought was a stable investment. And we still don't have regulatory clarity around crypto. So number one is the SEC has got to address this issue. And whether it's them on their own or in partnership with the CFTC, the markets need more clarity in crypto. And with more clarity in crypto, you're going to see more of the tier one firms able to provide liquidity, able to provide research, able to help enhance price discovery. That will help the market mature into whatever it's going to become. But you want your tier one firms to help make that maturation process happen. That comes with regulatory clarity. I think the meme stock phenomena, we spoke about it for a few minutes here. I think the SEC was in a really tough box about how to handle that moment in time. Freedom of speech issues come into play. Really hard. It was very clear that some of the trading had in its basis this idea of hurting others through short squeezes. It's borderline market manipulation when it gets into that level. But I think that's really tough for the SEC to have addressed. I don't know what they should have done on that front. It's a really interesting intersection of First Amendment rights, social media, and financial markets. And I just don't have the right answer to this because I'm such a huge believer in First Amendment rights. I think that's really dangerous area for us to tread in terms of regulatory matters. And then the regulatory agenda for this year, they dumped 700 pages of new regulations into the market as my holiday present for all of us in this room. We got that present.
Did you read it all?
I have not read all of it. I have other things to do with my life, but I've read a lot of executive summaries that make me want to cry. And it's a lot of regulation with reasoning behind it that I don't understand. Like, you often see regulations, you go, I understand what they're trying to get at. And for much of this, I don't understand what wrong they're trying to right or what information asymmetry they're trying to address. And so that's very worrisome to me, because the United States, with debt to GDP at roughly 130%, with a wall of entitlements ahead of us, Washington, in every dimension, has got to be focused on grow the damn economy. If we grow the economy, that will help on the inflation front, that will help bring more people back into the workforce, that will help us address the promises we've made to those who are going to retire. And yet, out of Washington, the current rhetoric and action plan is about slowing down the ability for our country to move forward. I mean, this idea that we're going to tax companies as being anti-inflationary is the most absurd concept I've ever heard of. Like, we're going to tax our companies that need to invest in CapEx, invest in hiring people, invest in training their workforce, which all this will happen in smaller quantities. We're going to tax these companies, and we think that's going to reduce inflation? I mean, like, just go take out a simple economics book, for God's sake. So I really worry about where we are on the regulatory front right now, because we need to go the exact opposite direction. We need to encourage investment in capital and in people to grow our economy to meet the promises that we've made to the American citizens.
So one of the things that the SEC is looking at also is concentration issue amongst market makers. That's not something that you think is there.
Look, Gary can look at it all he wants. Market-making business is extraordinarily competitive. The team at Virtu is very good at what they do. The team at Susquehanna is extraordinarily talented. I face really tough competitors every day. If he wants to spend time analyzing that, God bless. Like, go for it.
Is there something that would make it acceptable to you in terms of either disclosure or best execution requirements?
Look, we have advocated that all the retail brokerage firms should report their execution quality in their public disclosures, because we think that form of transparency furthers competition. And to be clear, we think we're the best competitor. So in a market that's more transparent, where the benchmarks are clear, we'll bring our best game to the table every single day, so will everyone we compete against, and the consumer's going to win. And we've gone nowhere with this with the SEC for gosh, it must be 5 to 7 years now. So what's really interesting is whether it's us, or it's Virtu, or it's Susquehanna, we put a lot of ideas in front of the SEC that we think are very clear-cut, pro-competition, pro-consumer, pro-market structure, and have gotten nowhere. Why don't we have half-cent ticks in the most liquid names? I don't, there's no good answer to this. Jeff Sprecher and I spoke about this in front of the Senate, ballpark 2015, 2016. It's unbelievable that when the largest exchange and the largest market maker both go in the most liquid names, we can have a tighter bid-ask spread. And we're getting stiff-armed by the SEC to do this. It's incomprehensible that we're being criticized for being anti-competitive. I have a very simple framework. I hire really good people. We invest an extraordinary amount in training and development. We empower decision-making. All we want at Citadel is a chance to compete. That's all we want.
What real regulation do you think will come from the SEC in the next 12 months?
I have no idea.
Do you ever speak to the chair of the SEC?
I have spoken to Chairman Gensler, and to be clear, I'm a little befuddled here. He is very sharp. We worked with him a lot when he was at the CFTC on Dodd-Frank. And Dodd-Frank, which opened up competition in derivatives, has been a home run, an absolute home run for end users of derivatives. I mean, it has saved tens of billions of dollars a year in the derivatives market by end users. In fact, Bloomberg, kudos to Bloomberg, is one of the biggest platforms today for trading interest rate swaps on the back of Dodd-Frank. So I've seen Chairman Gensler do some really great things to improve the competitiveness of our markets. I'd love for him to play that playbook, because that's how we're going to create surplus for the consumer, is we're going to take out deadweight loss in the economy, we're going to make people bring their A game to work every day, and that's how consumers win.
But just so I understand, you think they're looking at too much regulation, or they're misunderstanding regulation? Like, what's your real beef with him right now?
No, my real beef is they're dumping hundreds of pages of new regulations that are going to reduce the incentives for active management. They're going to make it more difficult for hedge funds to run their businesses. There's adverse consequences to private equity. To what end? Like, I don't know what to end. If I could tell you, hey, they're doing this because it's going to, do X, Y, Z for the benefit of consumers, I'd sit here and tell you about that. I don't have that story. So that's why I'm perplexed. Like, I'm just kind of perplexed. I'm not usually that perplexed either.
Talking about the nickel market, I mean, that was pretty crazy what happened on the LME. What does that mean for the LME?
Oh, boy. That was one of the worst days in my professional career in terms of watching the behavior in exchange. We didn't have any meaningful position in nickel at all. I'm not sure we traded a single contract that day. I don't know. It wasn't material to us. But to see an exchange close and then cancel hours worth of activity was just utterly, just incomprehensibly wrong. You cannot do that in a market that is integrated with other markets. What if you traded on the exchange, then had a back-to-back over-the-counter contract? What if you were a producer selling your production forward, and now all of a sudden you find that you didn't hedge? I mean, there's all kinds of adverse consequences that come from exchanges changing the rules of the road after the fact. In the FTR market, we saw PGM change the rules of the road a few months ago with respect to the price of power between 2 points in the marketplace. Every time you see these kinds of regulatory interventions, or in this case, an exchange acting in a way that I can't understand, you undermine market integrity. And on the back of that, you have the whole cascade of you reduce participation, which means you reduce research, which means that you reduce the effectiveness of investment made. And consumers pay for that in the end.
So what, the LME shouldn't survive? It should be restructured? There will be lawsuits?
Well, there's going to be lawsuits. I mean, for sure. I mean, that's just the nature of the situation. Look, I think this points to the necessity of clarity on exchange rules. And if the LME, for example, had a rule that they will halt trading on the back of a certain size move, everyone would have known that up front and behaved accordingly. The key to successful regulation is you make the rules of the road clear. And I spoke about that actually in my hearing with Congress on GameStop, which was you just make the rules of the road clear. If I have to drive on the left, I'll drive on the left. If I drive on the right side, I'll drive on the right. Just tell me where I need to drive the car. We'll follow that. And the LME changed the rules of the road. The PJM changed the rules of the road. When you interfere with markets on an ex post basis, it's incredibly destructive to the meaning of markets.
And so what does it actually mean for the LME, you think?
Well, LME is seeing a dramatic decrease in turnover across a number of their products, and you're going to see liquidity move to other venues, and you're going to see people drop out of markets.
Ken, on philanthropy, so you bought, the U.S. Constitution, there was a Blue Origin flight. Like, how do you choose what you buy?
Those are two very different questions tied into sort of a question. So first of all, most of my philanthropy is not about what I choose to buy. In fact, 95 or 96% is. I'm very focused on ways to increase opportunity and access and education. So to me, my father was the first in his family to go to college. My grandmother grew up so dirt poor they had no running water. And what has made my life possible is my access to education. Went to a public high school in South Florida, had the opportunity to go to Harvard, started Citadel after college. That is a story of the power of education. And so have been very committed to initiatives that open the doors of education to as many as possible, which regretfully means I deal a lot with K through 12 education and spend a lot of time trying to push back on the impact of teachers' unions. Because right here, right now, as we have for 20 years, we see the teachers' unions put the interests of the teachers in front of the interests of the students. But education, by far, has been my big focus over the years, and that's the story behind Blue Origin. The Constitution is a totally different story. It's the founding document of one of the great moments of exceptionalism in the world. And I get frustrated with all the endless self-criticism of America that takes place today. Take a step back. It's the first successful story of representative democracy. Our origin story is not perfect, but it is the origin story of America, which has been the most followed model in the world over the last 250 years. This is what success looks like. And the Constitution of the United States has so many important ideas in that document that define who we are as a people and the values and beliefs that we stand for.
You're involved in politics. How much are you willing or expecting to spend in this election cycle?
Oh, I'd love to spend zero. Love to spend zero. And I'm not excited to be involved in politics. I'm involved in politics because I've seen what happens when you have poor political leaders. And right now, I live in a state that's the case study of this. Detroit was the wealthiest city in America per capita in roughly the 1950s. Detroit. And I bought hundreds of copies of a photo book on Detroit. The photographs were shot about 7 or 8 years ago. And in these photos, Detroit looks like like it was like the Ukraine. I mean, you cannot imagine the devastation in Detroit in terms of dilapidated buildings, old theaters that are just destroyed. I mean, it's like the Ukraine. And that's a story of policy failure in a state. And Illinois right now is going through the same chaos. You know, our decisions not to enforce the laws means that, you know, as awful as the event was that happened a few days ago here in New York, that happens every weekend in Chicago by noon on Saturday. There have been, in rough strokes, 20 to 25,000 people killed in Chicago in shootings since I moved there 30 years ago.
So you want to make a difference?
So I want to make a difference. And I have found that political leadership is a really important way to make a difference. That no matter how much money that we put into philanthropic efforts, if you bring in politicians who are not going to fight for the kids, and they're not going to fight to have safe streets, and they're not going to be oriented towards how do you build a business community, you end up with Detroit. And you know, Chicago with Mayor Daley, with Rahm Emanuel, was a thriving, vibrant city. And with J.B. Pritzker as governor, I've seen our state literally awash in just lawlessness. I mean, this weekend, for example, outside of our headquarters in Chicago, hundreds of kids on the sides of the streets throwing things on passing cars. And by throwing, I mean like throwing shopping carts on passing cars.
Would you get into politics yourself?
I'm going to avoid getting into politics.
Why?
I could not imagine running in this day and age where every time you turn around, somebody's taking a cheap shot. And it's really easy to take a cheap shot, not based in fact or reality. And then you're left with the headline story that's just the proverbial fake news. And when you go to try to right the ship and get the real story out there, that's page, you know, C17. No one ever reads it.
But is that social media, or is that?
You know, I think it's a combination of social media, and it's that headlines today are all intended to be as inflammatory as possible. You know, in a day and age of how do you create clickbait, you want the headline that is just like the most over-the-top headline you can possibly generate, and the truth is a second-order issue.
We're almost out of time. What are you most optimistic about, and what are you most pessimistic about in the next 12 months? It can be politics, economy.
So I see the clock. I got 31 seconds here. I'm going to run the clock.
We can push it.
Because I'm going to end with optimist
We can
only.
push it.
Look, I'm most optimistic that there is a sense, I believe, in our nation of we're heading back towards the center. You know, you see it here in New York City with the new mayor. You saw it in Virginia with the choice of governor. I think there's a rising sense in the United States that we belong as a country back towards the center. I'm optimistic about that in terms of the midterms and about the diminishing of the voice on the far left and the far right, which does not represent where our country is or should be. So I'm optimistic about that. I'm really worried about where are the millions of Americans that should be in our workforce. Because every day they're not, they're losing really important life skills. You know, people give the Fed a lot of criticism for having been slow to raise rates. But you have to give them a lot of credit. They brought roughly 10 million Americans back into the workforce. And it's much more important to protect the human capital of our country, first and foremost, than to deal with what we believed at the time to be transitory inflation. Now, there's no doubt the Fed's been throwing two really big curveballs, the COVID zero policy in China continuing to persist, which creates supply chain challenges there, and now the war in the Ukraine. But big picture, we have brought our economy back to full employment nominally. We still need to bring millions of Americans back into the workforce. And if we don't, the loss of productivity and the loss of new ideas and creativity that would come from those people coming back is a really big loss for our country.
Ken Griffin, thank you so much for your time today.
Pleasure to be here today.